So, what the heck is going on with private credit? It feels like anytime I see it mentioned in a news source or a financial commentator, something's going wrong. And for me, I'm someone who doesn't necessarily keep up with the space all that much. I made a previous video discussing kind of my thoughts on private credit, but it's really concerning to see any time I look or open up a news source that something's going on with private credit. Right now, what appears to be going on is a lot of private credit firms are kind of limiting withdrawals from their funds. And so I wanted to take us back and see what's actually been going on. Why am I seeing things about big implosions in private credit and people bringing up the 2008 financial crisis and try and discern my own opinion from all the noise that's going on. So, first things first, a lot of individuals may not necessarily know what private credit is, and also it sounds like depending on who you ask, you're going to get vastly different answers as to what private credit actually is. So, I'll try and give a brief introduction into the concept of private credit and my own knowledge base on private credit. So, private credit really took effect after 2008. That was because banks were very hesitant to lend money, especially to riskier borrowers. And so these investment firms and private asset firms, in a way, wanted to kind of step in and lend their funds and reap significantly higher reward based on the riskiness that they were lending. Additionally, private credit has also kind of propped up a lot of the leveraged buyouts that you see private equity firms conduct. I know private equity is probably the more popular of the two areas, but this is basically when firms want to take public companies and make them private. So they buy out, and that is kind of private credit's kind of fueling where they're getting those funds from. For me personally, as I mentioned earlier, I made a video that actually covered a bit on my thoughts of private credit. A significant quantity of my knowledge from private credit actually came from an informational webinar slash sales pitch by a company that was, well, giving private credit offerings. Basically, my interpretation and what I was left with from that video was that private credit sounded like there was a ton of opportunity for the investment firms that were actually doing the lending. That's because a lot of them were being very selective, or at least this company was being very, very selective. They said they took on low single digit requests. And by the time it actually got to the third party investors, your pension funds, your sovereign wealth funds, even at this point, some individual investors, by the time it got down to them, the expense ratios were just insane. And it seemed like the risk didn't necessarily match the reward with what you actually ended up getting. That being said, private credit, especially in the late 2010s, early 2020s that we're in, it really did seem like this almost too good to be true thing. They had massive returns. And this, in a way, is kind of the first time it's really being tested, in a sense. Now, as I mentioned, there's a lot of concerning news going on about these actual, well, firms that offer these private credit funds. Specifically, a lot of them have been making news for limiting withdrawals. Just with everything going on, it makes sense that investors would want to pivot out of more risky assets into more safe assets, even in fixed income. So a lot of them are asking for, well, redemptions back. And basically, a lot of the firms have introduced, well, they originally had them built in, but they had 5% caps that they could enforce in terms of withdrawals. Now, the sad thing is, a lot of people are all trying to pull their money out at once, and it is significantly over that 5% mark. In fact, some of them, it's as high as 20%. They're asking for 20% of the money in the funds to come back to the individual investors. And a lot of these companies are just saying, no, we have a 5% cap for a reason. It would be irresponsible of us to liquidate 20% because when you're liquidating significantly more than just the 5% that you expect quarterly, then you're also having to sell off your really good loans that there's nothing wrong with, and it's destroying everyone else who's actively staying in this fund. But overall, that's really been making a lot of news. For me, I first kind of grew aware of the situation when the household names started doing this. We can go back to November 2025 and we can see examples of like the Blue Owls doing this. And that's a name I was familiar with, but not truly familiar with all of the things they were doing in private credit. But when BlackRock and Blackstone and Apollo start going through this, that really opened my eyes to this situation. Now, I really remember at the end of my little sales pitch because my boss tasked me with trying to figure out, well, what's going on with this private credit, and of course with it being a wealth management firm and they're trying to sell their products to us, should we be putting clients into this? I really left with just a kind of meh reaction to private credit for me personally. And again, that largely boiled down to the fact that when you took out all of the expenses you were paying, it didn't seem like the risk quite matched the reward in the end. It seemed to make a lot of sense for the companies actually doing the lending. And by the time it got passed down, it made a lot less sense, in my opinion, versus traditional bond ETFs of high yield category if you were going for a more risky fixed income approach. And so I vocalized this, and I did end up saying something along the lines of, it seems a little 2080. And what really made it stand out to me in that front was that one of the interesting things that got brought up in this webinar was that a lot of the actual companies that offer these private credit funds own each other's funds. And so it's like this weird web in a sense. And so I saw a way for it to kind of be like a domino effect catastrophe if something were to really go wrong in private credit. And I think those fears and concerns are being brought up now. So while I can be like, oh, I was right on my gut opinion, I was way late to the party, obviously, and people really did vocalize that concern with much more expertise than myself, a college student and an intern at a wealth management firm. But it is a little bit nice to see that my initial opinions might have been a little bit correct. Now, in terms of the how did we actually get here portion, I want to visit us back to 2025. That's where we really saw a lot of this kickoff. First off, we saw some companies in the private sector, some not necessarily household names, but some larger companies file for bankruptcy. And this started to kind of, everybody was worrying about tariff concerns and economy concerns and job concerns. And now you have some companies that are filing for bankruptcy that people actually may know or have maybe purchased their products. It got a little bit jittery. And especially when you're dealing with companies that, well, are then lending funds to these types of companies. Not saying that the bankruptcies that we were seeing were necessarily one to one, oh, they're in all the private credit funds or anything like that, but it was definitely a little bit jittery. Now, I mentioned Blue Owl earlier, but they were one of the ones that kind of kick-started some of the concerns. If we go back to November 2025, they had brought up an unlisted fund to basically appease their investors. They were going to merge this fund to kind of let some of the investors who wanted withdrawals get out. However, analysts were quick to realize that when these two merged, in order to actually get your money out and withdraw, you were going to have to take a 20% haircut. Now, here's the thing, I'll give a personal example that I witnessed at my internship as to why I don't think that's necessarily the biggest concern in the world, but definitely if you're being pitched this idea as this is going to be beneficial to investors and suddenly it comes at the cost of a 20% loss, yeah, you're not going to be excited. And that kind of started the train of people rushing to the exit door in a sense. Another area of major concern actually has to do with everyone's favorite topic right now, that being AI. Private credit, in a lot of ways, is severely tied to software companies. These are going to be pretty risky companies that have high risk to rewards, and AI has kind of shifted in a way. People originally thought that AI was going to be a major benefit to software companies, and while I still think long term that makes a lot of sense, we now have questions as to, is AI going to replace software? And maybe there are people with the technical know-how that can really give a concrete answer to that well, but at this point in time, it really does feel like a lot of speculation. I don't necessarily think it's going to be one end or the other. AI completely destroys the software industry and just does all of that, or AI becomes this godsend and suddenly software companies are, ah. I think it's more likely we see kind of an adaptation of current software companies where some of them may get lost, that their pure purpose that can be done by AI becomes AI, but those that are like more complex can really utilize it to grow, and we see them become more efficient. That would be how I would guess this plays out, but again, that's purely speculation, as is pretty much everyone's opinion on the issue, except those with significant technical know how and years of studying this industry. But software being so heavily tied to private credit in the 2010s and early 2020s was seen as a real positive. And again, you're dealing with a high growth sector. So obviously these companies, like, they burn through cash, yes, but the successful ones that are probably making it through all of the very critical screening that these companies employ analysts for and yada yada, the firms that are actually getting access to these funds are most likely going to be winners. And being a winner in software means you're going to continually be burning through cash, but also growing rapidly. So it was kind of like a win win. And now it's being viewed as much more negative because we just don't know what AI is going to do to the software industry. Additionally, this private credit mass fear and trying to leave all at once couldn't be happening at a worse time. Global tensions are kind of at a melting point in a way. We're seeing this with the war in the Middle East. There's a lot going on right now, and investors are panicked. And we're seeing that from a flight of from risky assets to more safe haven assets. We can see that with the explosion in gold and in silver, and additionally we can see that in fixed income. But overall, investors are taking away from their risky portfolios and their risky allocations, and well, private credit is kind of viewed as a, well, very risky form of fixed income, which I think plays to its benefit long term. I'll talk a little bit about that in a second, but overall, it's one of the first things to go when you're trying to fly out of the risky assets and go into the safe haven assets. Now we get into my opinions on what actually happens now. Now that we're watching this unfold, is this a 2008 situation all over again? Are we seeing the implosion of private credit similar to the mortgage backed securities? Well, I'm a little bit on the fence. But first, let's just talk about the simple fact that investors are trying to panic out and withdraw significantly more than the built in 5%. To me, this screams a pure misalignment in the proper investments for these individuals. And I say individuals, but at this point right now, sure, there are definitely actual individuals in these funds, but a lot of them are going to be pension funds and sovereign wealth funds. That's going to be where the majority of the money is tied up. And then you'll also have the wealth management firms that I mentioned where they've put their clients into things that they probably shouldn't have. Now, from a logical standpoint, when we're dealing with illiquid funds, trying to pull all of your money out at once, and again, that's an oversimplification, but it does mean that these companies, in order to either appease the investors or just blow them off and say, no, we're hitting you with that 5% cap, you can wait in line. If they want to appease their investors, as I mentioned earlier, they're going to have to sell a significant quantity of really good assets. And what's worse is they aren't necessarily going to be able to do these at a fair market value because, well, they're being demanded to sell them right now and give the money back to investors. So this might mean that they're actually forced to sell them at what we would consider fire sale prices. Basically, if you've ever seen a store, let's just make this a very simple example. If you've ever seen a store, say a furniture store, you see this all the time with them, and they're going out of business. They don't want to, the owners don't want to be stuck with like 350 different couches and chairs. So what do? Well, they usually will slap on a major sale. Some of it they might even sell at a loss just so they don't have to hold on to it and they can get some cash out of it at least. And so they'll probably mark everything down by like 50%. That's the situation that can happen if these funds are forced to actually appease the investors and give withdrawals much more than they would plan to. Is they're selling these really good assets at steep discounts. And from any sane investor that has seen this as a long-term position in their portfolio, this makes no sense. And they would be absolutely upset to see the fund that they put their money in sell a bunch of good assets at losses because people are panicking. Now, I don't want to make it sound like I'm putting all of the blame on the investors. And I have a very, very simple reason. And sure, it might be like taking a one example I saw and applying that generally, but there are people who have been caught up in this who really shouldn't. And I'll give a personal example. So, at my wealth management internship, we had a client who was very old and had cancer, and they unfortunately passed right at the beginning of my internship. And, that's typical with people who are old and have cancer. But one of the things we found was that this person liked to, well, spread their bets and diversify. And that included working with different wealth management firms. And one of these firms had decided that this old man with cancer, what they could really benefit from was being put into private asset funds that had like a 15-year payoff. Now, this obviously is the exact opposite of a fiduciary duty. This was really upsetting to watch. But what was worse was the hurdles that you have to jump through to actually get out of this. And one of the reasons I said that the 20% haircut wasn't necessarily horrible was because we had to argue with the companies that actually ran the funds in order to kind of get out with as much of the capital as we still had. And we ended up having to shave off a 25% about from their initial investment. So they actually didn't get anything from their time in the private assets, and they took a 25% cut. And at the end, what's really upsetting was that was actually pretty good. That was a negotiated, we got as much of the capital out as we could that they had in their long litany of papers that no individual investor is going to read because they assume the wealth management firm that's managing their money is going to read. And it was just a pure misalignment of what was actually good for the client versus, I assume, what the wealth management firm was putting all of their customers into. And you get a lot of examples like this. Sure, you have sovereign wealth funds that didn't really think through this and stuff, and sure, you have funds that you've kind of earned this by not doing your due diligence. But there are unfortunately individual people who are going to be hurt by things like this and will have been put or convinced into these funds that don't align with their objectives, and definitely not time frames. Now, from a pure speculation standpoint, where do I see this going? I'll make the bold statement that I do not think this is going to be the end of private credit. I think when a lot of people talk about 2008, they just focus on, well, the implosion of the mortgage backed security market. And then they think, oh, that was the end. And it really wasn't. Mortgage backed securities today are bigger and bolder than ever. But that doesn't mean that they didn't go through a massive implosion and scrutiny and the subprime market wasn't hit significantly. What came about that was more regulations and more guardrails, and of course, now the mortgage backed security market looks quite different than it did. But honestly, I think private credit might go through a similar thing. I think this might invite more legislation and guardrails into private credit, but I don't necessarily think that an implosion in private credit means it's the end, that I see some commentators and journalists pitching that it is. And there are some simple reasons for that I'll get into, but right now I don't think it's going to be the implosion. Now, one of the things that is worrying about private credit right now is that we get a rate of default rate that is stated at about 2.5%. But a lot of people are critiquing this and saying it's actually higher when you take into account the companies that are basically not going through the bankruptcy process but kind of begging for more time on paying back their loans. And when you account for those companies additionally, it's actually closer to about 5%. And so this is definitely worrying if you have firms that are lending money to these types of companies. But overall, I don't think that's going to be a major impending doom in private credit. Now, one of the reasons I don't think it's going to be a 2008 catastrophe, and one of the things that really plays to private credit's advantage, and admittedly, I've seen a lot of people touch on this, and I think it makes a considerable amount of sense, is that private credit has always been seen as risky. There hasn't necessarily been a statement that private credit is this super safe thing. When we go back to 2008 and we look at the mortgage backed security market that kind of imploded in the CDOs, these were all viewed as very, very safe. And that meant companies felt, well, completely justified in leveraging up to insane quantities, sometimes 30 to 1. So taking out major loans and then also investing that into the mortgage backed securities. With private credit, it benefits from basically always have being seen as risky. And so companies are less likely to do that, and you're less likely to see major institutions like banks do that at all. So I think that's going to be one of the things that benefits private credit in this implosion. I still think it might go through an implosion, but I don't think it's going to be the end. Overall, I've mentioned it multiple times, but I don't think this is going to be the end of private credit. Companies that are always risky and will not necessarily benefit from getting lending from banks or the bond market are going to search for funds. And I think private credit gives the opportunity for investment firms to, well, benefit by giving them these funds. And quite frankly, I like having something that juices the fixed income market. And it's because fixed income, I've said this repeatedly, depending on your time horizon, obviously, but if you have a long time horizon, fixed income is incredibly dull. It's so hard to get excited about middle of the pack single digit returns when the S&P 500 over 20 years has done like 11% annually. It's not exciting at all. And there needs to be something that will give investors the chance to have riskier fixed income allocations outside of just your corporate bonds or riskier governments that really does kind of boost fixed income significantly. And I like that about private credit. And for all of the mentions I or all of the reasons I mentioned earlier, I don't think this is going to be the end. I think this is going to be a great opportunity for private credit to weather the storm, right? See the problems. The firms are going to see, okay, what's going wrong? How do we make this a safer long term thing? There might be some regulation that hops in place, but overall, I think this is going to become an evolution of private credit. I know obviously it makes for a better video if I'm like, this is the end of the financial world, we're all cooked. But I don't think that's the case. To the individuals who are kind of stuck in this because, hey, we can't withdraw all at once, I'm very sorry. That really would suck. I do think it's quite eye-opening though, because I covered a video where I was talking about potential legislation to put these in 401ks. And I think now a lot of people will have their eyes open and it won't be assumed that this is just risk-free, fixed income is entirely risk-free, because a lot of people they kind of have those perceptions. Like just general public, obviously not individuals who really keep up with financials at all, but general public views bonds and all of these things as very risk free, and they aren't all the time. And I think this is eye opening, and hopefully, this makes people do their due diligence with all their investments. Overall, thank you so much for watching my video. I really appreciate your time. Thank you so much. I hope you have a great rest of your day.